Well, speaking about Janus Henderson and how you invest, part of the reason you're here today is because you have a CBOE listed active ETF, JFix. And we want to talk about, I guess, like how investors and advisors can add fixed income to a portfolio, because I would hazard a guess that for most of the last decade, the majority of people listening to this were underweight bonds. Like fixed income, you were pretty unloved in the scheme of things. On one hand, you had Mag 7 ripping. On the other hand, you had, almost zero rates for most of the 2010s. But things are changing. And are you starting to see that change in the sentiment you're hearing and the conversations you're having with clients?
Definitely, yeah. I have seen a return to some allocations towards fixed interest, fixed income, as also known, and credit as well. And over the last couple of years, after a bit of a painful period in terms of core fixed income, where interest rates were moving higher quickly and those markets sold off, a lot of people have talked about those defensive characteristics having come back to the fore. And one of the old sayings now, everyone's saying bonds are back. I think the way I'd term it now, when you're talking about fixed income, the income is back in fixed income. And when you're looking at fixed interest, if you want to call it that, the interest is back in fixed interest.
Nice.
So, I'd say, the income's come back. You've got that nice defensive yield coming through. You don't have to really go right down the capital structure or up the risk spectrum to try and get that yield that you're looking for in your defensive portfolio. And, of course, when you're doing that, it's not as defensive. So you can go into these core bond funds such as Janus Henderson's Aussie Fixed Interest Fund, and you can get your defensive characteristics where in times of stress, then your government bonds, semi-government bonds, they rally. But then you can also diversify across lots of different areas of the market, which are very attractive on a relative sense versus offshore markets, which I can touch on. Get your defensive income yield and maintain that liquidity with your total portfolio.
We imagine that, I guess, a lack of interest may have led to a few misconceptions among clients. What are some of the misconceptions that you find most frustrating that, I guess, now you have the platform to address?
I think the answer to that, there's a lot of choice within fixed interest, and a lot of those investors out there, they get a bit confused and they don't realise that there's lots of different sectors of the market, and not all fixed interest is the same. It's very broad church. So there's area of the market you can lean into and lean out of, and for some investors that perhaps don't understand the asset class so well, they're pretty surprised with some of the returns that they got through the post-COVID period, but not realising that, in fact, there wasn't a lot of yield to offset the capital price movement. So now, if you were looking at past returns, you might think, oh, geez, that's a tough period. But now you've actually got these nice yields built in that it's a lot harder to get those sorts of negative returns, and we've got a pretty nice forward-looking outlook in the market. As an active investor, there is a lot of choice in the market, and we do lean in out of different sectors at different times. When yields are selling off or rates are selling off, then credit can perform a really good role in portfolios. You have nice income coming through, and you can have floating rate credit, which actually moves, the yields move up in line with cash rates or yields moving up. I think the misconceptions are things are all the same and into one bucket, but there's lots of ways that you can navigate the market. That's why active management's important.
Well, to illustrate that, if there are lots of buckets, what's the bucket that you're finding the most appealing at the moment across the Australian landscape?
Well, the most appealing, I think, in the times of crisis, it's government bonds, semi-government bonds. They have offered value where you do have that liquid portion of the market, and they have rallied in times of stress. Credit has been an area that's been in favour for the market. Fundamentals are pretty strong in Australia, and people have had a look and said, hey, look, we're attracted to the spreads. But spreads have moved quite a lot tighter versus where they were, say, 5 years or so ago. So we do favour that nice level of income through our credit positions, but we do like to take bigger positions in safer things. We've got a laser focus, as I mentioned before, on defending making sure that when you're looking at your asset class allocation, you want to be defensive, you want that nice income coming through, but you've got to have diversification. So we're diversified across sectors, government bonds in portfolios, semi-government and credit, and we're moving it around just to try and make sure that we're trying to deliver those attributes that people are seeking in the portfolios.
Nice.